It's in the.
What I said is that the portfolios don't take effect until the close of trading today. So you can technically, you get a free trade basically until 4:15 today. We got, some people have even said, I'll email you later in the day what my position is. It's fine.
But we can still be in treasuries overnight. We can still stay in the treasuries.
You can stay in treasuries overnight or a couple of days if you want. That's not a problem. Okay? Yes.
Minor question on figuring out the 30-day T-bill rate. We look at the T-bill section and try and find one.
Yes. Yes.
Can we repeat that?
Yeah. Now how to get the interest rate?
What around the T-bill? We have the T-bill.
Oh yeah, so the treasury bill, you can always look at the, go to the, I think it's called Treasury Bonds and Treasury Bill section. Yeah. And there's one that you should be able to find that's close to the expiration of the option. And that's the rate you can use for discounting. Like you can't do a lot of the questions in 2A yet, right? Because it says use a Black-Scholes formula or something. We're not quite there yet. Okay? Actually, do you have any guesses? Okay, can we have them introduce themselves?
I'm going to let them introduce themselves. Brian,
Brian O'Neill, I live in Pennsylvania, and I am a rock climber.
So I'm going to ask you to derive the Black-Scholes and continuous time. I know these are admissions tests.
I'm Brady Bayless from Houston, and I work with Bank of America now at the University of Texas.
All right. Okay. Let's talk about the schedule from the hyper syllabus. Today we've got assignment 2A, and today we're doing options. And Thursday, we're supposed to do, today we're supposed to do futures. We're running a little behind, but it's not that bad. So this is what my plan is. What I'm going to do is to get through some of the, well, I won't be able to even finish options today. But we'll get them to the Black-Scholes formula today. Which means that you cannot turn in your futures portfolio on Thursday. I don't think that's going to be reasonable, even though the part 3A is just a little more work than what you did for 2A. Easy to do. I'm not going to require that because it's we won't have talked about anything to do with futures. So on Thursday, what I want to do is to finish the options, teach some examples and stuff like that, and maybe introduce futures on Thursday. And then the second part, we're going to go through the midterm exam from last year. And then Monday is the midterm. So that means that futures will not be tested on in the midterm. So there's only like two things we have to worry about: bonds and options for the midterm. So push the futures into the future, I guess. And I need to get the futures assignment 3A in. So instead of having it due on Thursday, and it's kind of repugnant to have it due the day of the midterm, what I thought we could do is to hand it in even by email, perhaps, the day after the midterm, so Tuesday. Okay. So I will repost the due dates and the syllabus changes every lecture. Okay. Okay, good. So what I want to do is to continue, if there's no other questions. Also, this assignment 2, you know, if you didn't attach your money, you can give me the money by the end of the day. You can email me your position. You can, and don't feel you have to hold the same position for the whole assignment. Okay, if you can trade, it's costless to trade. There's no transactions cost to actually do it. Okay, so, but as I said at the last lecture, just don't call me to do the trade. I'm not the broker time as secretary. And you should email CEB4. Okay? Yes.
I'm sorry, maybe I missed this question earlier, but I'm just confused as to whether if we decide to invest in options, do we need to have the omega and all that kind of stuff calculated prior to the trade, or we can just go ahead and do the trade and then that's due upon?
Later.
Okay.
Yeah, so everything that you couldn't do for 2A, by Thursday you can do everything, I guess, but you don't need to hand it in until the end.
You don't need to hand it in until Part B is due?
That's right.
Okay.
Okay, well let's continue on options. Let me give you some examples of options that pop up. Last lecture I said that they're all over the place, and they truly are. A discount corporate bond. Suppose we've got a company that's got equity and it's also got debt. The form of the debt is a 1-year, 0 coupon bond. And suppose that bond is due $60 million. At the end of the year, if the corporation doesn't have $60 million in value, then it's going to go bankrupt. When it goes bankrupt, the bondholders are first to be paid. They get paid whatever the value of the firm is, let's say $50 million. The stockholders are the residual claimants on the firm. They get 0. If the value of the firm is above $60 million, then the bondholders get paid, and the stockholders get the residual. So, in a firm that has a capital structure with debt and equity, the equity holders have a call option on the value of the firm. And the strike price of the call option is the face value of the debt. The time to expiration is the expiration of the debt. So it's kind of an unusual way to look at equity through the view of option pricing. So we can extend this intuition to coupon-bearing bonds, where now we've got a series of coupons, a series of potential bankruptcies at every coupon date. And we can model, again, the equity as a series of call options in a portfolio that's put together. Now, after assignment 1, I assume that you're bond valuation experts. And hopefully, even though it was a long assignment, you did learn a lot from doing that assignment about bond valuation. And I hate to tell you, but you've done the most rudimentary style of bonds. This is basically what we call straight bonds. There's other bonds out there that are more complicated, such as convertible bonds and callable bonds. But the good news is that after today's lecture, maybe Thursday's lecture, they're not as complicated as one might think. And we can value them fairly straightforward way. So a convertible bond gives the holder of the bond an option to convert into stock. So at some point, the contract of the bond has got a timed expiration, it's got an exercise price, it's got all the same parameters that we would think for a regular option. And it turns out the way to value the convertible bond is to use what we did in assignment 1 to value just a regular bond, and then use what we're going to do like today and Thursday to value the option. And you put them together, and you get the identical payoffs of the convertible bond. So by the principle of no arbitrage, that if you put the straight bond and the option together, you get the identical payoffs to the convertible bond. Those two portfolios must be worth the same, or there's arbitrage opportunities. So it turns out it's not so bad that we actually have to do what we did in assignment 1 to start off with. And then we have to add an option. The other example is the callable one. Now, callable bond is quite popular, actually. Even government will issue callable bonds. And what does that mean? It might mean that the bond is issued at a certain price, and usually the coupon on the bond is pretty close to the going interest rate. And the government, what it would like to do is, if the rates go down, the government really doesn't want to be paying a high coupon. So they'd like to call the bond back and reissue additional bonds at a lower coupon rate. And that's the idea of callability. So if it's the case that we issue a bond at, let's say, an 8% coupon with 20 years to maturity, and interest rates drop from, let's say, 8% to 5%, on the regular bond that you valued, what's going to happen to the price of that bond? Because it's going to skyrocket. 3% change in rates. Rates down by 3% on a 20-year bond. It's going to go way above 100. So, if this bond is callable, what will happen at some point, the government will call the bond back for some price above par, let's say 105. And then the government will refinance the debt at a lower coupon rate, let's say 5%. Now let's think about that. If you were offered two bonds, 20-year bond, both government bonds, one is an 8% coupon, the other is an 8% coupon. One has the callable feature, and the other doesn't. Which one are you going to pay more for? Non-callable. The one that isn't callable has got a huge upside, that the price can go very high if rates go down. The one that's callable, it's got a lower upside. Because as soon as the interest rates drop by a certain amount, the government's going to call and reissue. So you don't get the upside. Yes?
Is there a certain guarantee on how much of an upside you may get? So I mean, if it drops like from 8 to 5.
Yes, so it won't be exactly, it will not call necessarily at par, it will be above. So there will be some upside. Yes?
How does the government figure out at what price to call? I mean, how do they figure out what the cost of refinancing is? You know, so how much will they give away before it becomes worth it?
I'm not sure that they really think that carefully about it. I'm not sure how much science there is in actually doing the cost-benefit analysis. I think that there's more science for a corporation to do it. But then it becomes really complicated, and in the advanced corporate finance course we talk about it, that the firm might not call the bond, even though the price of the bond is above the call price. Which seems irrational, but it's like you're kind of giving the bondholders, or you're doing them a little favor, giving them some extra price appreciation. So it's much more complicated. But the corporation thinks of it, whereas the government, the treasury, is just like, just not convinced. You know, I don't know for sure, but just like such a sprawling amount of debt that I'm just not sure how much control it has.
Is it constant? I mean, is that something that there's a certain spread they've used historically, or does it vary widely?
Yeah, the government actually stopped issuing callable bonds. The ones that they issued were when rates were relatively high.
Yeah.
The call feature for those was actually, I think it was on 30-year bonds, and they weren't callable until they became 5-year bonds. And government bonds are always callable at par. Corporate bonds usually have like a whole slew of schedules. So for example, a 30-year corporate bond, what they might do is they have the right to call it after 10 years, maybe at a price of 107. And after 11 years at a price of 106. And the schedule kind of goes down until a few years beforehand it's callable at par. And usually they'll make the decision on something a little more rational. If you don't mind going on with it.
No, that's okay. I'll put it up on the web.
They'll make the decision usually on a more rational basis than like an individual might. But you know, as Campbell pointed out, they're not going to call it immediately. There are kind of two reasons for that. One is that they don't want to piss off the investors, and the other is that they may think that rates are going to go down more. And they can't just keep refinancing because there's a cost of refinancing. But individuals can do the same sort of thing if you have a mortgage. If rates drop, you have the right to essentially call your mortgage, refinance your mortgage. And in general, the payoff for that, because you have to pay points up front, is quite high. And usually people don't do it until they're about 2% below where their coupon rate was.
Sounds like it'd be very hard to evaluate if you had that whole schedule of different years, things like that.
It's difficult to
Got the
evaluate.
schedule. That's the, like with a callable bond, if you've got a schedule, that helps. For a mortgage, it's way more complicated. Okay, because people refinance their mortgage not just because the rates go down, because they might move. Right? So you really don't know. And also, you kind of trust that corporations, at least their treasury departments, are kind of more on top of the interest rate environment than maybe the average mortgage holder. So they're a little more, the corporations are more predictable. They've got the schedule out there. There might be something else going on, like you said, and some of the stuff in the advanced corporate course also. But for a mortgage, it's very difficult to forecast the things. There's all these people that specialize in kind of forecasting the when the call is exercised. You've even got the possibility that somebody's got a mortgage at 17% rate that doesn't refinance. There's mortgage pools floating around, 15% or even higher.
They just don't understand the concept.
That's one reason.
That's one potential reason.
There's actually another reason for it. I actually worked for the guy who created the first prepayment model on Wall Street. And I asked him in particular, why do these people still have 15% mortgages? And the answer was that the government is supporting 12% of that, and they're really paying the 5% mortgage, which is just incredible.
Yeah. So there's support, there's like some people, they can't refinance.
I would say that was the phase out of the itemized deductions you want. If you have a high level of income, you want a high level of deduction.
Or their property value dropped, which is another reason. That happened in New York a lot. The property value dropped?
Yeah, and that's basically that they can't get another mortgage.
Exactly.
Yeah. So people whose credit risk is so high that they can't go and say refinance me at the going rate. Okay, so it's really like the Money and Capital Markets course does this. This specializes in this is like a real important part of fixed income, the intermeshing of options and kind of straight bonds. So that's offered in fall 1 next year. It goes through all of these exotic sort of things that you can put on bonds, straight bonds, to make them more interesting. Now, the U.S. government hasn't issued calls since the 80s, though some of those bonds are still outstanding, right? There's other governments that just routinely put these call features on. Okay, other government bonds that are out there. There's even things like, I think I'm going to mention this in one of the first lectures, where you've got an option of taking the straight coupon or the appreciation in the S&P 500 index, or the appreciation in the price of gold. Just to make the bond a little more complicated, you've got like 3 things you can choose from. The coupon, 8%, the S&P, or the gold. But again, the idea here to value this is go after the straight bond, go after the option on the S&P, go after the option on the gold. Create a portfolio that has the same payoffs, and it must be the value of that exotic bond. I guess we could call that an exotic bond.
Seems like it's approaching more equity than debt.
Absolutely. Okay, what else do we have? Warrants. Warrants are call options issued by a firm. Everything else are going to be, most of the options we talk about are going to be options that are issued between people like us that are traded on the exchange. If you open a Wall Street Journal, you can see exchange-traded options. Warrants are issued by the firm, and sometimes they're given out as an extra, like with a dividend. Sometimes a firm like Intel recently last 2 years, raised a substantial amount of equity using warrants. So they had an equity, basically a warrant issue, I won't call it equity, but that raised a lot of capital. Everybody see that the firm, a put warrant is not that popular of a warrant issue for a firm. These warrants are usually long dated, and the exercise price is way above the current price. So the exercise price, you know, if the stock is trading at $50, it might be like $120. That's got like 7 years to go. You don't see the case of a firm issuing a put warrant where it's valuable if the price goes below $5. It's kind of like you're sending the wrong signal to the market. That this is only, if you're giving something to the shareholders you think is valuable, and it's only valuable if your stock price goes from $50 to $5, then you really have to wonder what's going on with the firm. So it's very unusual to see, though it has happened before, put warrants. Yes?
How are warrants affected by stock splits and stuff like that?
Well, how are regular options affected? So suppose that I've got a put option, and the strike price is 100. The price of the stock is $90. Okay, which is, I've got the right to sell at 100, and the current price of the stock is 90. Okay. And that's good news, right? Then, you know, some stuff happens and the price goes to 100, it's bad news. Price going up is bad news for the put, you're betting on the price to go down. It goes to 110, it's worse. 120, the option's way out of the money and basically worthless. Then the firm announces a split. And we go 2 for 1. The stock price goes from 120 to $60. Now, are the people that own the puts dancing in the street? No way. It's too easy. So what happens is that the exercise price, which was $100, gets cut automatically. So it goes to $50. You're still up. So it really doesn't affect. Other than the information that's kind of revealed by a stock split, which might be that we think the price is going to go up even higher. Other than that information, there's no extra money to be made on the split.
But you do get twice as many contracts.
That's true. The value's the same. Okay, so what else do we have? Executive compensation. You need to know option theory for this. Okay. And I've seen there's actually a whole big controversy as to how to account for these options. And basically, right now, they're not accounted for. So it turns out that at the time when they started doing this, there was some controversy as to how to value an option. And because there was a controversy, they decided not to value them, to completely keep them off the books. They appear nowhere, which is like saying that the option that they're issuing has zero value. And even the weirdest option pricing model would assign some value to these options. So it's a real controversy right now, and there's you know, a group that wants to use the Black-Scholes model for valuation of these options and to put them back on the books. But there's a number of firms that are very much against this. That as soon as they do this, it means there's huge charges for the firm. But the way I look at it is it doesn't make any sense, that argument, because the number of stock options that are issued are public knowledge. And we're smart enough that we can figure out, we can actually go and calculate the value of the options ourselves. And certainly people that track the stock do that, so they know what the liability is. The market knows what the liability is. So when it's actually put through with these accounting changes, I can't see that there's going to be any impact whatsoever. So it's kind of like the only way that argument makes sense is if you believe that people really don't bother to calculate the value of the options when they value the firm. This doesn't make any sense. No rational person trying to value a firm would ignore these executive compensation options. Yes?
It isn't a big issue that executives don't want you to know how much they're really getting paid.
Well, it's not well, their compensation, right, includes the value of the option. Could be, but, you know, that's not a very strong argument. Yeah.
I'm actually somewhat surprised because if they were counted, that would be part of the executive salary, which is a deductible expense, which is to reduce their taxes.
Yeah, but it's an expense nevertheless.
Yeah, it looks bad on their books, their profits go down, but as far as the strength of the company as a whole, it would probably go up.
Well, yeah, kind of the way I look at it is that people do that anyways. You know, when you're looking at the firm, you got to take that into account. So it's a real expense. So I just don't think it's going to have any impact. Also, leases often have options to buy. So basically, what I'm trying to say is these options are all over the place. And so we need to know what to do. So let's go through some examples.
Excuse me for a second.
Yes.
When you were talking about discount corporate bond, what is that? Did you say about equity holders, about getting a call option? It's kind of like getting a call option on the debt. Is that what you said?
No, the value of the firm. So
Oh.
think of the payoffs to the equity holders. If the firm is worth less than $60 million, they get 0. If the firm is worth $61 million, then the debt holders are owed 60, and the equity holders get 1. If it's 62, they get 2, and all the way up. So if you graph that, it looks exactly like a call option.
Yeah.
So it's a very simple firm where it's got just one piece of debt, and it's got like 1 year to go. But the intuition can be extended more generally so that equity holders are very much like option holders, call option holders. Okay, well let's go through some strategies. And the first one is where you buy the stock and you sell a call option. And it's called a covered call. So the blue is buying the stock. The red is writing a call, and you get a premium for doing that. And notice that the exercise price is 6, that if the stock price goes beyond that, you start losing with the call. However, you've got the stock, which is going up, so your portfolio return is kind of flat. So why would you do this? You got the stock, why would you write a call? Well, you get this extra area here, this difference between the dotted line and the blue line. If the stock price doesn't move that much, you get this region. If the stock price moves a lot on the upside, then you're not really losing anything other than kind of an opportunity lost. So, you know, I kind of phrase this in the note as making a little extra money by writing calls. Yes?
This is reflecting a gross payout. We're ignoring what you paid for the stock. The point being
Yeah,
that-
exactly. So we could redo this with a net payout for the stock also. And that would just shift this blue line over. But this is a gross payout for the stock. Okay. Using options instead of stock. This is a strategy where I buy a treasury bill and I buy 2 calls. And there are the 2 calls in red. And when I combine them, I get the green dotted line. And notice that compare this to just buying the stock, which is in orange. It doesn't turn out too clearly here. But notice that if the stock price goes up a lot, I do better with the green rather than the orange. If the stock price goes down a lot, I do better with the green compared to the orange. But there is this region here where the stock price doesn't move that much, where just buying the stock has a better payoff than the T-bill plus the 2 calls. But essentially what I've done is I've got like a payoff from this strategy that's an alternative to just buying the stock. There's some attractive features and there's some negative features. The negative feature is this middle region. And I think one of the more attractive features is that the downside is effectively capped. That you're not going to lose more Well, the value of your portfolio is just going to be the T-bill minus what you paid for this option.
So could you give an example of what kind of stock you might like to do this with? Do the T-bill plus 2 call.
You can do this with any stock.
But what would be when would we want to do this?
Well, when would we want to do it? I guess one thing is that we probably think that the stock is going to move either up or down. Right? So if we don't think the stock's going to move that much, then we're going to lose in the middle, in that little region there. But if the stock moves a lot up, then we're going to get a bigger payoff. And if it moves down, then we're insured. Okay, so we can do this with any security, literally. IBM, AT&T, we can invest in options rather than the stock.
But you would want to do it if you think that the stock is going to move one way or the other a lot in a short period of time.
Yes, and there's other strategies we might want to pursue also on that. But this is just one way. It's just an investment payoff. Yes.
Wouldn't the strategy, I mean, you would be thinking the stock would move more up than it would down. I mean, the strategy, correct? Is it, I mean, as you're saying last class, you think the stock's going to move a lot, but you don't know which way. Would you buy puts and calls every time?
You could, but that could be expensive to buy this option. Right? This is you're just buying a call and a treasury bill. You know, it's a different payoff. Right? A call and a put, if I put that together, it's going to be like a V. It's just a different style payoff. Where you're benefiting both the downside and the upside. So that's going to be more costly than if you're benefiting on the upside, but you're flat on the downside. Right? So it's just your choice. So this is just options instead of stock. Portfolio insurance is another example where you've got the stock, which is in blue, and you buy the put, which is in red. Put them together, and you get the green. And notice, again, you've got kind of a floor on the value of your portfolio. And then you get the upside, like the stock, less the value of the insurance. So put is sometimes called insurance or protective put. So you're paying for it. In the upside, you don't get everything. There's an insurance premium there. But in the downside, you've got this floor. So it's just another example of how to do an alternative investment.
The put is in the same stock.
Yes, that's very important. Same stock. Okay.
And you buy the number of puts that matches the number of shares that you have?
Right, 1 for 1. Okay. Okay, what about determinants of value? Like what we're getting towards, what we're going to do first is just the relative value of a call and a put. But then next, we'll talk about to actually value an option. We need an option pricing model. Yes?
Quick question that we just went over. When you have a put strategy or a call strategy, does it matter in terms of whether you have options in the way out of the money or in the money or out of the money in these strategies? I mean, are the movements of those prices going to matter that much in terms of imaging the stock price?
The exercise price turns out to be quite important for the insurance. Okay, so suppose this is an example where the exercise price is $490. Okay, so the insurance starts to kick in at $490. Suppose the current price is $490. Basically means the insurance is kicking in if the price goes down from today's price. That's going to be an expensive put option. Now, if we decided to take insurance at $470, that means that the insurance starts to kick in if the price goes down from $490 to $470 and below that.
So it's basically just trade off between premium and how much
Exactly.
risk is.
Exactly. So it's just the level of insurance that you want to buy. Yes?
Do a lot of mutual funds use this strategy? Or can they? I mean, if they're buying in huge blocks, does this become something that they can't do?
Do mutual funds use portfolio insurance? Not usually, because this region here, you really, if you're compared to a firm that doesn't use portfolio insurance, you're going to have a lower return on the upside. But let me tell you what some of them actually do. Anybody have like a money market mutual fund? One thing that I found, I found quite unusual about that was I was looking at returns of money market mutual funds. And I know what they invest in. You know, treasury bills, CDs, commercial paper, high quality, bankers' acceptance, it's all high quality. And you know, like over the year, I kind of follow all these rates. And the past year, I noticed that every single one of those rates is below 6%. So I know they invest in these things. But then I look at the money market mutual fund returns, and they're above 6%. So given they invest in all these instruments that have a yield less than 6%, how can they show a return on the fund above 6%? And they've also got a lot of costs that they've got employees and building and limousines, whatever. How is that possible? How can they get above 6% return when every single thing that they've invested in that we call money market is less than 6% return? How is that possible? Or they're doing something else. Options, I hear options. They are writing options. They're writing options, and they're making this little extra amount. And in writing those options, they are able to exceed the 6%. It turns out it's very widespread. It turns out that you have to report, the mutual fund has to report to the SEC every 6 months, their positions. And often you don't even see these options in the reporting. You know why? Let's get rid of them the day before the reporting. And then people say, well, the SEC should report quarterly. So get rid of them the day before the quarter. So it's very difficult to figure out what a lot of these funds are doing. But you can be assured that most of them are doing this. And the reason that they say they do it is that they're ranked, by all these services. Whatever consumer reports with the smiley faces, get 3 smiley faces. That's very, very good, I guess. And if you're ranked with a simplistic ranking like that, and somebody else is writing options, you have to write options too. Or you're going to fall below the person that's ranked. So it's like a real circular sort of situation where everybody's writing because everybody's writing. But beware, when you write options, you give your upside away, and if you're writing more than you've actually got to cover, then you could be in a loss situation. So as for mutual funds, they don't usually buy options, they usually sell them. Depending on the style of mutual fund, it might be like an active investment mutual fund that might do something else, like buy options. Okay, let's talk about the determinants of value. The first thing is the current stock price. So it's going to have a differential effect on the call and the put. If the stock price goes up, the value of the call must go up. Yeah, you're betting on the price to go up, so it better go up. We've got an option to buy at $100. The price goes from 100 to 110. That's good news. If we've got an option to sell at 100, and the price goes from 100 to 110, that's bad news. Because with the put option, we want the price to go down. We're agreeing to sell at $100, and we want the price to go down, so we can go into the market and buy it at 90 and sell it at 100. If it goes up to 110, we're not going to go into the market and buy for 110 and sell at 100. So the put is hurt by the stock price going up, whereas the call benefits. Now what about the exercise price? The exercise price, if it's very high for a call option, remember the call gives us the right to buy at a certain price. So the higher, we have a higher exercise price, then there's a lower chance that the call is going to exceed the exercise price. Okay. So let's actually, I've got another quotation here that was larger size than last time. Still will probably be difficult to read, but that is the maximum 156% that I could do at 5 to 8 in the morning. Let's look at Cisco. First column is the final stock price from Friday, and that's 84.25. Second column are various exercise prices. The third column are expiration dates. The fourth are the volume of the calls, and the fifth is the call prices. For one call option, we multiply by 100. And then we've got the volume of the puts and the last put price. So let's look at the December 85. It's got a price of 5 and an 8. December 85 has got a price of 5 and an 8. And if we go to the December 90, so it's a higher exercise price. December 90's got a price of 3. So the price drops as we go from an exercise price of 85 to 90. The idea is that there's a lower probability that the final stock price is going to be above 90 compared to above 85. Okay, so therefore, the option with the lower strike price, the 85 strike price, is going to be more valuable. Yes?
Does the volume mean how many of the options are outstanding?
No, the actual trading.
Trading.
Yeah. And notice that some of these are pretty thinly traded, where there's one with only 5. There's one with 5 contracts traded. Very small amount of volume.
Is that a contract for a single share or a
That's
share?
take 5 multiplied by 100, and it's the number of actual options. Yes.
Is there substantial liquidity risk in some of these?
Yes. If there's very low trading, then it's going to be hard to get in and out. What about the put option? How does this exercise price work for the put option? So as the exercise price goes up, that means you get the right to sell at a higher price. Is that good news or bad news? Good. You always want to sell at a higher price, right? So let's go to the quotation, and maybe we could find the same option. The 85 December is 5 and 5/8, and the 90 is not traded, so that didn't work. Let's go to the January. So the January 85 put option is trading for $7, and the January 90 is trading for 9 and 5/8. The price goes up. So as you move the exercise price up, the option increases in value for the put. Okay. We'll open the Wall Street Journal and go through these effects. Okay. The first one was what happens if the price changes. So then you need 2 days of Wall Street Journals. This is for a price of 84.25. Maybe look at tomorrow's journal, and who knows what the price of Cisco is going to be. Maybe it moves a lot. Then you'll be able to see the impact of the price change on the call option and the put option. Yes?
Is there any place that gives you kind of a trend of over time for these? Besides
Trend
just-
of what? Trend of the stock price or the option price or?
Well, I guess that I'm talking about the stock, because I was looking at this stuff this morning trying to realize it, and it just tells you if it's up for the 1 day, right? Is
You
there a
have to
place
go to
that
another
gives you a
service.
history?
Like, for example, data stream in the library, you could download and it graphs very easily what's happened with the stock price. Cisco is stock has been a big mover.
Okay.
I think last year it was trading about $50. It's now 84. You can see some of these strike prices are real low, 50, 60. So it's moved a lot. The other effect, yes.
I'm sorry, I just was wondering, is there something that has a more complete listing of the strike prices for options, or is that just like listed in the
A trading screen.
The the trading screen on?
Well, if we had like a trading room
So,
or something.
right, so yeah, but we can't access that?
We can't access that.
So we really are limited to that sort of what we're
Yeah,
seeing?
unfortunately.
Okay.
Data Stream does have some option quotations, but it's not that good for options.
Because it's just like, I was looking at the other day, and you know, the strikes that you see in the Wall Street Journal are so close to where the stock is trading now
That's
that it's
right.
kind of hard to do. I thought
It might be that those are not even offered.
Right.
But sometimes they're like just drops, so as I say, I wish we had that
Right,
trading.
okay. I just wanted to know if I was missing something or
No,
if that was.
no, but that's the idea, when you issue the actual, like when the options are decided to be listed, that they'll try to pick ones around the exercise price, because those are going to be the ones that are
That
highest
are most
volume.
actively traded, right?
Yes.
I don't want to get tangent too much, but what is the status of like us getting a Bloomberg terminal and that type of thing? I mean, is it coming?
Yeah, well, we're going to get 2 terminals?
Yeah.
I've been asking for 9 years for that. So, and Bloomberg is not my first choice. It's very difficult to actually download data off Bloomberg. It's great for fixed income, but for other stuff, it's not as good. So really, we need like a live Reuters feed, a satellite on top, and a trading room. That's what we need. But unfortunately, we need a donor first. We need somebody to make some money.
Maybe the new dean
most
will know
schools.
someone. Maybe the new dean will know someone.
Yes, maybe. So that'd be nice.
Campbell, what we do in this exercise if some of the strikes are dropped, like as we go on, we bought the 50s,
Yeah.
we bought some calls.
In a drop. So basically, what you're going to do if your option drops out, I guess I'm not doing a very good job of recruiting. I should watch out. Next year, we'll have Bloomberg and maybe so we got Data Stream actually. There's only like 3 or 4 schools in the country that have Data Stream, and it is the premier data service. And it's very expensive also. Corporate subscription is $110,000. And we got a slight deal, $35,000. Still for a school, that's a lot of money. So you get 15-minute delay, but it's not a lot. Reuters is actually not that bad. After you get the satellite, it's like 100,000 a year. No deals. So it's not that bad. But you need to set up the room. You need workstations and PCs. Ideally, you have a workstation and a PC next door to it. The workstation doing valuation, and the PC with all the graphics and free. We've actually got a proposal. If you look at the finance homepage, you'll see the details of our proposal for the trading room. So it's actually, we're working on it actively. And they're working on it also, but it's a matter of getting going. So maybe financial. Okay, what was the question? If the option basically drops off, then what you're going to do is to track it daily based upon the Black-Scholes price. So we have to do the Black-Scholes formula first to get the Black-Scholes price. So we're going to track it at kind of a phantom price. The other effect here is timed expiration. Timed expiration, if it increases, that's good for both a call option and a put. And the idea is that if there's more time, then there's a higher probability that the stock price is going to exceed the exercise price for the call or go below the exercise price for the put. So more time is good. And you'll notice if you go and track these for more time, so the calls, for example, the 85s, November, December, and January, the price goes up. 3, 5 and an 8, 6 3/4. So as we get more time to expiration, the price goes up. And for the put, it's the same thing. Same 3 options, 5 and 5/8, 7, and then the next one, 3 3/4, 5 and 5/8, and 7. Okay, so more time is a good thing for the options. Yes?
As the value of the underlying stock changes, are those increased maturity associated with the option going to react linearly, or will, if I choose to buy the December rather than buy the November, the stock goes up $1, you would expect the price of both of them to go up, or are they both going to go up a again, in a linear
Okay.
fashion.
Again, we have to wait. We have to wait for the Black-Scholes. And there's going to be a measure that we're going to talk about called the delta. And the delta tells us for a $1 change in the stock price, what is the dollar change in the option price? And I'll give you the delta for each of these options. And it might be similar, but they'll probably be different. So you can actually, and is it linear? And if you've looked into the Black-Scholes formula, is it approximately linear? If you're at the money, yes. You can get a good approximation. But if you're trading big time, we don't want to make any linear approximations. Go with the non-linear model. Okay. So there's time to expiration. There's other effects, two other effects that are less important, like dividends and interest rates. The idea of the interest rate is that what we want to look at today is not just the exercise price, but the present value of the exercise price. All right, we always want to discount. If the interest rate goes up, what happens to the present value of the exercise price? It's down. And that's going to have an effect on the call, it's going to have an effect on the put. Now, it's confounded by the fact that an interest rate change might impact the stock price too. And the last effect that's really important, well, there's 6 of them, but the one that's maybe the most important to understand is volatility. If the stock becomes more volatile, the returns become more volatile, then that means that there's a higher probability of the call finishing in the money and the put finishing in the money. It has a positive effect on both the call and the put. So volatility increases means the call price will increase and the put price will increase in a nonlinear fashion. It has the same sort of effect. There's a number of things. The main effects on the call and put prices are going to be the underlying stock price, the exercise price, some effect of the interest rate. The volatility is going to be really low. So next, what I want to do is to link the calls and the puts in hopefully a simple way. Yes.
Just the mechanics. If you own a stock and you wanted to write a call, you call your broker, say I want to write a call on the stock. Are you basically just going to get whatever price is being traded right according to these prices, if that's an existing option? What if it's not existing? If they're not traded, will your broker, maybe
make the
will they actually make that, or will they say that doesn't trade?
No, well, it depends on who your broker is. So you can do a so-called over-the-counter trade, and basically do whatever option you want, whatever exercise price you want, whatever time expiration, they will do it for you. And then they'll go out and they won't necessarily hold the other side. They'll go out and try to sell that to somebody else or hedge it.
And the market will determine.
As for you getting the money, you're not necessarily going to get any money whatsoever. Or you might actually have to put some money up. Good faithfully. Okay? And again, it depends who you are. So the mechanics depend, who you're actually doing. With the short sale examples, you have to be real careful because short selling, you think money's coming in, but actually it could be the money actually goes out, unless you're totally hedged.
On that kind of lingo when we use it, selling short. Is selling short the same thing as saying I'm writing a covered call? Or
no, it's the same thing as writing a call. A covered call is different because you're combining a call that's being written and the stock which you're holding. So you're truly hedged there. Right? So if you're hedged like that, then you are getting the premium. You're writing your hedge. Like the money market funds. They've got the underlying assets. They're good credit. So they can do right. They can buy the treasury bill and write an option on the trade. Okay, well let's talk about the relative prices of calls and puts. It's called put-call parity. And the first one is I'm going to construct 2 portfolios. And I'm going to establish that each of these portfolios has the same payoff in every single state of the world in the future. And I'm going to argue that the value of these portfolios today must be identical by no arbitrage. Okay, that's where I'm headed. So the first portfolio, portfolio A, is buy the stock and buy a put. We already did the payoff diagrams for that. So what's that called? What do they call that strategy? Buying the stock and buying a put?
Insurance?
Portfolio insurance. So buy the stock and the payoff, and I'll look at two possibilities here. S star is less than or equal to K, which means the final stock price is below the exercise price, or S star is above K. If I buy the stock, I just get S star. Whatever it is, $50, $150. If I buy a put, and if the stock price exceeds the exercise price, then the put is worth 0. If the stock price is below the exercise price, then the payoff is K minus S star. That makes sense? Well, in our example where the exercise price is 100, you've got the right to sell at 100. If the final price is 90, then this option's in the money. So we go K minus S star is 100 minus 90. The payoff to a put option. Now let's add up these two components. S star plus K minus S star equals K. And S star plus 0 equals S star. And this is a total payoff. And this is just what I use to plot that graph of the portfolio insurance. That's portfolio A. Portfolio B, I'm going to buy one call, and I'm going to invest the present value of K. Okay? If I buy a call, if the stock price drops, I get 0. If the stock price exceeds the exercise price, I get S star minus K. In terms of the example I keep on giving with the exercise price of 100, the stock price goes to 110, I know I'm going to get 10. So S star minus K is 110 minus 100. Invest the present value of K. So let's say K is 100. Let's say we've got a year to go. Let's say the interest rate is 11.1%. What am I doing? What's the transaction? What am I investing today? $90. So I'm buying like a 0 coupon bond that's got 1 year to go for $90. At expiration, 100. K. Okay, so simple transaction. So investing the present value of K is as simple as buying a treasury bill. So I've got two portfolios, portfolio A and portfolio B. Portfolio B, I can add up the payoffs here. It's K and S star. Notice these portfolios, there's a total of 4 things, but there's nothing that's overlapping. So portfolio A, it's got 2 things in it, and portfolio B has 2 things. They don't overlap, they're different. However, notice that the payoffs of portfolio A and portfolio B are identical. And they're identical in every single possible state of the world. And what I mean by that is S star could be 0, S star could be infinity. They're identical. Therefore, by the principle of no arbitrage, the value of portfolio A must be the value of portfolio B today. So we've looked at expiration, at the final payoffs of these 2 portfolios are identical. Therefore, the price of the portfolios today must also be identical. Now, if that's the case, then we get a relation immediately between the call and the put. And this is the formula for put-call parity. The stock price today plus the put must equal the call price today plus the present value of the exercise price. This must hold or there's going to be an arbitrage opportunity. Now, this is an equation that's got like 4 things in it. There's a number of different ways that I could write this equation. So I could write it in terms of the put, I could write it in terms of the call, I could write it in terms of the stock price, the present value of the exercise price, whatever I want, I can mix it up. This is something that definitely should go on your cheat sheet for the midterm. Okay? Definitely. You know, I've taught this for a number of years, I still forget the formula because it's always in front of me. So don't bother memorizing, you can do that if you want, but there's more important things to spend your time on. Yes?
Can you say it in wordage again? It's stock price plus
Stock
put
price today plus the put price today
Okay.
equals the call price today plus the present value of the exercise price.
The exercise price is the one with the strike price?
Yes. Exactly the same. And actually, if you think of these two portfolios, it's almost, the first portfolio was like a portfolio insurance example. The second portfolio is just that example of using the call option instead of investing in stock. Remember both those scenarios, you kind of had like a floor and the maximum loss that you could take. And both you had an upside. So, you know, diagrammatically, they're identical. And this just shows the two payouts. Stock plus put is the green dotted line. And this is T-bill plus call. So there's the T-bill plus the call, green dotted line. Identical payouts. So it must be identical price today. And this covers, as I say, every single possible state of the world. There's a link here which I recommend that you take a look at. I'm not going to link to it. But what it is a series of graphs. And there's the strike price of 50, and there's eight things you can add to the graph. There's the call that you buy, a written call. A put that you can buy, or a written put. Stock, or selling the stock. Borrowing the present value of the exercise price, or lending, investing. 8 things, and you just kind of like play with these payout diagrams and layer different combinations together. And I think it's useful because you can actually figure out how this put call parity works by playing with these arbitrage relations. So that's there. It's a bullet under option pricing, okay, in the index page. Okay, well, what about dividends? Put call parity with dividends. Well, we're going to take the same basic approach of 2 portfolios. The first portfolio is going to be real simple. It's going to be just a call option. So if S star is below K, that's bad news, we get 0. If S star is above K, we get S star minus K. Okay? The second portfolio is going to be a little more complicated. We're going to buy the stock, so we're going to get S star. And now we're going to borrow. We're going to borrow 2 things. We're going to borrow the present value of the exercise price, and we're going to borrow the present value of the dividend. So let me give you a scenario. We've got, let's say, 5 months to go on this option. The time to expiration is 5 months. We've got a dividend that's been pre-announced, and we know it's going to be paid in 3 months. So what I'm saying is you've got to do 2 transactions, 2 borrowing transactions. The first one is that you need to cover the exercise price on a 5-month loan. So suppose the exercise price is 100, and suppose that a treasury bill that's got 5 months to go is priced at, let's say, 95. So what are we going to do? We're going to borrow 95. In 5 months, we're going to pay back 100, which is K. Now, I've also got a dividend. And suppose that dividend is $10 dividend. And it's going to come in 3 months. I'm going to borrow the present value of the dividend also. And suppose again that I see the 3-month, not the 5-month, the 3-month Treasury bill, and it's trading at, let's say, 98. I'm going to go out and borrow $9.80. In 3 months, I have to pay off 10. So there's 2 transactions going on. So let's say we do that, and the last thing in the portfolio is to buy a put. So we go along 3 months, and the loan, the first loan is due. We have to come up with $10. How do we do that? We got the dividend. We own the stock. So we got the $10. We take the $10. We pay off that part of the loan. So it's gone. So the dividend is taken care of. And what we're left with is this loan with the present value of the exercise price. And at expiration, we owe K. That's why it comes in with a negative sign. Put this together, S star minus K and K minus S star equals 0. Over here, S star minus K plus 0 equals S star minus K. Again, what we've done is we've added a layer of complexity, which is the dividend, but we've preserved the basic idea of this put call parity. So portfolio A's value today must be the value of portfolio B, and we can extend the put call parity formula to incorporate the dividend. So in this case, it's the call equals the stock plus the put minus the present value of the exercise price minus the present value of the dividend. Okay? So the dividend is the extra component that we're adding to the put call parity formula. And below, I've also put the formulas for the present value operator in terms of e to the RT. I could do it differently. I find a mistake that people make a lot on the midterm is that I tell them the price of the Treasury bill is 5 months ago is 95. The Treasury bill is 3 months ago is 98. And then what they do is they figure out from those prices the interest rate. And then with that interest rate, they discount the exercise price and the dividend. You see that there's potential waste of time in doing that exercise? So if I give you the price of the bill is 95, calculate the interest rate based upon the 95. Then you calculate the so-called discount factor, or the price of the zero coupon bond that we use for discounting. What is that price? 95. That's what you started with. So don't do that. If I give you the price of zero coupon bond, that's saving you some time. It's not increasing your time. So I might give you the interest rate, I might give you the zero coupon bond price. If I give you the zero coupon bond price, then you don't have to do anything except multiply it by the exercise price. Okay. So this is the formula for put call parity with dividends. And it's just a timeline that shows the dividend comes early. And let's, before we take a break, do an example. Okay? And then when we come back from the break, I'll add to the example a little bit of complexity. Okay? The example is we've got Xerox trading for $61. We've got an April 60. That's sometimes how these are quoted. Xerox / April / 60. 60 being the exercise price. Sells for 7 3/8, and the April 60 put is 3 1/4. The call, put, and a Treasury bill all mature in 4 months. Okay. The Treasury bill price is $94.92. Again, I'm giving you the Treasury bill price. No dividends to make it easy. And there's 4 questions basically. Draw the position diagram for one call, long one call, short one call, long one share of stock, and long one put. So remember, long equals buy, short equals sell. And then it says, using the call, put, stock, and bond, demonstrate how you can make arbitrage profits. Ignore dividends, premature exercise, and transactions costs. Okay. Well, the first part of this question is quite easy. And this is that question is drawn up, I should give credit for it, drawn up an old midterm of Myron Scholes at the University of Chicago. Here's the call option payoff. So we should be able to do this payoff diagram. So the payoff, the net payoff, takes the price of the option into account, and it kinks up at $60. That's part A. That's pretty easy. Buy one share and write one call. Well, here's the share, and then we lose the upside when that written call goes into the money. Buy the put, well, that's pretty easy too, right? Buy the put, so it just looks like this kink diagram with a kink at 60. And now, let's consider the possibility of arbitrage. So we're going to use a put call parity formula. And notice I've written a slightly different way. C minus P minus S plus PVK equals 0. So I just threw everything on the left-hand side. So what is the present value of the exercise price? Well, the exercise price is 60. Multiply it by the T-bill price, or the price of zero coupon bond. So it's $56.95. Plug into the put call parity relation. So C is 738 minus P, which is 325, minus S, which is 61, plus PV of K, which is 56.95, and it equals 0.08. And what I say here is the inflow is pretty small, 8 cents. It's not worth actually trying to arbitrage this. So even though the question says ignore transactions costs, I'm kind of ignoring that part of the question. You know, technically, if I say that, you should say that this is an arbitrage opportunity. Practically speaking, it is one. Okay? That there's computer programs that are running, checking this equation. Okay? And remember that the call and the put have the same time to expiration and the same strike price, and that strike price is K. They're constantly checking for a violation of put call parity. And as soon as there's a violation, some trading signals will go out. So what this does is it kind of solidifies a relation between calls and puts, the stock, and the present value of the exercise price. They're all linked together by this arbitrage situation. Yes?
Suppose it had been a significant amount, what exactly should the option?
And that's exactly what I'm going to do when I said I was going to complicate things a bit when we get back from the break. So I'm going to say what happens if the price of the call is not 738, but it's 830. What are we going to do? And once we go through the mechanics of the actual trade, I think it'll help you understand what this put call parity is all about. So let's have a break and we'll start with that. Okay, let's change this example. And what I want to do is to increase the price of the call from 738 to 838. So now there's going to be no ambiguity. This is going to equal the dollar rate. This is a genuine arbitrage possibility. Okay, we have to do something about it. So before we actually go through and figure out what to do, it's always good to kind of think it through first. So is it going to be the case that we are going to be buying the call option or writing the call option? What do you think? Why? Yeah, it's like moving from 738 where this holds to 838. And you know, the odds are that it's relatively overvalued. So if the price goes up, we want to sell it. So I'll use the overhead for this. And all I've done is put the call parity formula up. C minus P minus S plus PBK equals 0. And then written the formula. And I've done this in a way that I suggest that you actually do. What I've done is I've put the formula in terms of a positive arbitrage profit. Like I could have written this formula as minus C minus P, or minus C plus P plus S minus PBK equals 0. And when I put the numbers in, I get minus 108. But if we're actually going to implement this, it's better to implement on an arbitrage profit. We want to lock in the profit rather than the loss. Okay? So this is what I'm going to do. And it sounds simplistic, but if you do it this way, then you just won't make a mistake. Or the probability of making a mistake is greatly reduced. Sign the cash flows in terms of today. So 838, that's a positive number. And minus 325 is a negative, minus 61. I just put like the signs of these numbers in. And then think through, how can I get a positive cash flow of 838 today? What sort of transaction, what action do I take to get a positive cash flow of 838? What do I do with the call? Sell it. Exactly what we said. We're going to sell the call. A negative cash flow today of 325 for the put means that I'm going to buy the put. A negative cash flow of 61 today for the stock means that I'm going to purchase the stock. And plus 56.95 is a positive cash flow. Does that mean I'm borrowing or lending? Borrow. So when I borrow today, I get cash to come in.
Can you repeat that one more time?
Yeah.
That's what you said.
For the borrowing or just the whole equation?
The whole thing.
Oh, okay.
Sorry.
So write the put. No, don't apologize. Write this with a profit. Okay, that's important. Sign each of the cash flows, positive or negative, and then take the action today that generates the sign of the cash flow. So a positive cash flow of 838 means that we have to sell something to get cash flow coming in. We're going to sell the call. A minus cash flow, cash out of 325, just means that I'm buying the put. Cash out of 61 means that I'm buying the stock. And cash in of 56.95 means that I'm borrowing the present value of the exercise price. So I'm going to do that all today. And I claim, well, not just me, option pricing theory claims that if you do all of that, you're going to get $1.08. And I think that's a pretty good claim to make. You just add it up, it equals $1.08. The real question is, what happens later on? So I get $1.08, but what is it going to cost me later on? And that's what we have to check. Yes?
Selling the call, is that the same as writing?
Yes. Sell, write, short. Same thing. Sorry. Yes?
My question, the original example, you're figuring out the present value of the call and the put, and you don't use it. You're dividing the call.
I said that the exercise price of that, right? Or the call?
Yeah, no, you're dividing the call and the put prices by the 0 coupon. You don't use it.
That's correct. And I don't think the payouts are based on that either, the diagrams. I didn't put that in. Maybe I'll strip that out because I think that's confusing. Okay, so everybody see that this, just by construction, equals $1.08. Now we have to pursue this possibility that, that there could be some cost later on. So let's go through, and this is another required step. What am I going to list? 3 columns. I've got the action today, and then at expiration, what happens if S star is below K? what happens if S star is above K? And I want to go through each of the things in my portfolio and figure out what the payoff is. The first one is selling the call. I know today I get $8.38 for that. If S star is below K, then I know that the call is worthless. The payoff is 0. If S star is above K, the person that bought the call is entitled to S star minus K. The stock price goes above 100, the payout is S star, the price, let's say, of 110, minus the strike price of 100 is $10. If I've written or sold the option, my payout is the exact negative of the payout of the person that bought the option. So I just put a negative sign around the S star minus K.
What does that say between the S star less than or equal to K and the S star greater?
Oh, sorry. It's at expiration. It's at expert. It's my short form for that.
Question. Zero.
Yes. Oh,
I mean, like, just conceptually, I'm just thinking in my mind, if the stock price was below the strike, so the kicked in premium, that would be the payoff.
Okay, what I'm looking at is kind of like the gross payoffs at expiration. Whatever premium is going to be over here today. Okay. So I'm just looking at my initiated position today. It's got some costs associated with it, but what I'm looking at, given that position, what is my exposure in the future? And a gross basis. And it turns out it's 0 if the price goes down. Next is, let's buy a put, and we know what the payoff of that is. It's K minus S star if the price goes down. If the price goes down to 90, and the strike price is 100, that's K minus S star is 100 minus 90. Yeah, keep on using those numbers. I think it's a good idea. It's easier to think in terms of an example, a simple example, than trying to remember if it's S star minus K or K minus S star. So I always like think of the two ways of doing it. If the stock price goes up above K, then it's 0. Remember, the put is a bet on the price to go down. Next, buy the stock. Well, in the scenario of the stock price going up or the stock price going down, it's always just S star, whatever S star is. And finally, we're going to borrow the present value of K, which means at the end we have to pay off our debt, and our debt equals K at the expiration time. So it's going to be a cash flow of minus K. And now we just add up all of the payoffs. And this column is today. And we know the payoff is $1.08. We've already established that. But what we haven't established is what happens at expiration. And notice that when you add all this up, you get 0. When you add all this up, you get 0. So we get $1.08 today, and there's no liability in the future. 0. There's no future cost to this strategy. So this example, what it does is maybe it makes you believe the put-call parity formula. If I did those general examples of put-call parity in portfolio A and portfolio B, this is a situation where you're actually implementing it, and it doesn't matter what K you use or what S star you use. It doesn't matter if the stock price goes to 0, the stock price goes to infinity. The payoff at expiration is going to be 0 for this strategy. It generates $1.08 today. So this is the ideal way to make money. You get cash today, and you don't have to pay out anything in the future. No risk. This is pure arbitrage profit. This is like the definition of pure arbitrage.
Just conceptually, where does the return, which of the components is the return from the borrowed present value of K? Is it in all those three, or is it In other words, ideally you're borrowing some money and then is there a time period between when you're borrowing and
Yeah, you're borrowing, and the time expiration of the debt is the same as the option.
Okay.
And I should also mention that that same expiration is the call and the put, and the call and the put have common exercise price hitting. Yes?
Can we always assume that it's risk-free to buy a put in terms of really getting the money from whoever
Yes.
sells the put?
Yes. And if you do that on an exchange, then it's virtually risk-free because the exchange guarantees. If you do it over the counter, there could be some counterparty risk. And that would be reflected in probably the price of the put. And then this might not hold exactly. Okay, so everybody see kind of what's going on here? You know, usually when I ask a question like this, and you know, again, you know, a good way to really understand this is just to go and create another example. Go to the Wall Street Journal, use the prices to do this. Go through the exercise. Now you're going to find some violations of put call parity for the Wall Street Journal prices, but they might not be real violations because some of the options might be thinly traded with low volume. They might trade early in the morning, and that's the final price reported in the Wall Street Journal. But from early in the morning to late in the day, a lot could happen. So you might even see weird things like, remember we saw when we went to longer time to expiration that the price of the call and the put always went up. You might see that that doesn't hold all the time. And it could be because one of these options didn't trade near the end of the day, and the price is not really a valid price. Okay. So beware of this, but this pretty well holds. As I say, computer programs are churning most of the time. In the developed markets in Chicago, it's very unlikely that there's going to be a large violation of put call parity. In new option markets, there's great gains to be made. Some country that's just opening up an option market find violations quite easily. Right? And in a way, they almost want you there to do this arbitrage. Because the more people doing the arbitrage, the lower the chance that there's going to be a sustained violation of the relative call and put price. So in a way, it makes the option market more efficient, which is an attractive feature for a lot of investors, except for the arbitrageurs. Yes?
Style of option matter at all in this relationship in terms of marrying your people? Since you're holding maturity?
Yeah, because this is really for a situation where we hold to maturity. It turns out that in most cases, the options are fairly short dated, and we could use like a European style option formula, like Black-Scholes is a European formula. There are versions of this put call parity with options that could be exercised early. It's just a little more difficult to implement. Okay, well let's continue. There's some supplementary sections that aren't obvious they're supplementary, but the minimum value of a call option is supplementary. The maximum value is supplementary. The effective volatility, you look at that, but it's pretty supplementary.
You mean just FYI? Supplementary?
Yes. Yeah, that's not question 2B of the exam. And I want to move right to the Black-Scholes formula. Okay, what I've graphed here is the actual histogram of U.S. stock returns from '79 to March '95. And there's the October crash. See it? Right there. One observation, October '87. Notice this well up on the tail. The red line is the normal distribution. So what I want to do is to develop an option pricing model for options today. The put call parity is not an option pricing model. It could tell us if the call is relatively overpriced compared to the put, but it's possible that both the call and the put are mispriced by the market. This is going to tell me what the price of the call is. Okay? Now to do that, we need some sort of measure of the chance or the probability that the stock price is going to finish above the exercise price. Remember, the call is only going to be valuable if the stock price finishes above the exercise price. So if I've got an exercise price of $100, okay, and let's say that the option's got a year to go, exercise price of $100, 1 year to expiration, and the current stock price is, let's say, $50. The question is, how valuable is this option? So what has to happen to the stock price for the option to be valuable? It's got to go above 100. We're at 50. The stock price basically has to double. And the question is, like, how do we assess the probability of a doubling? Now I can take a less extreme example. Suppose the price is $90 today. The strike price is 100. How much does the stock have to go up to be in the money? $10 in percentage terms, 11%. So what I'm going to do is I'm going to use this kind of normal distribution idea to help me make an assessment of the probability that the call finishes in a situation where the stock is above the exercise price. Final stock price is above the exercise price. So let's look at this distribution. Suppose that for this hypothetical stock we're talking about with the strike of 100, that this is the distribution of the returns, the historical distribution of the returns. And we're going to use the normal distribution here to help us.
So what is it of the y price? Is that just the density function?
Oh, left, right here, is the number of observations. That's not the density, or the probability. I guess we could divide by the number of observations. But it's just the number of observations. So let's use this diagram, and I'm going to highlight, if the stock price is 90, we need to go to 100, which is 11% return. What is the probability that we get an 11% return or above, according to this diagram? Not exactly, but just kind of like approximately. 5%. Everybody see that? That roughly speaking, that only about 5% of the observations are 11% or above. So if we're sitting at 90, and we got to go to 100, then, and this is rough intuition, but I think it's good intuition, that from the normal distribution, we can actually say something about the probability of exceeding the exercise price. So that's, roughly what we're going to do. What we're going to do is to overlay onto our basic option payoff for a call, which is S star minus K. We're going to bring that to the present value, and then we have to assess the probability that the call is going to finish in the money to get an expected payoff of the call. Yes?
Is this an industry-specific distribution? I would imagine if you were comparing...
This is the whole market.
But I mean, if you were comparing, like, if you're doing a call on a high-tech stock versus a call on a Fortune 100, I mean, your variability is going to be a little bit different.
Yes, and that's got to be taken into account. And the high-tech stock, if I drew the distribution, it's going to be like out here. It's going to be a lot fatter, bigger standard deviation. Yeah, it's going to be very important. Okay, so for that stock, what's the probability of it going up 11% or more? 30, 40%. For this stock, which is a diversified portfolio, which is the market, it's less likely. Yes?
So this is pretty much, you're assuming the market is rational. You don't need to know really anything else about the stock. This is just a way of using probabilities to estimate your results. It's not an analysis of that particular stock's value or the company.
You want the analysis of, we have to figure out the volatility of that particular stock. Right. The other thing here is, don't be tricked by this diagram. I said 11% for the annual return. These are actually monthly returns. Okay. Here's the crash observation, minus 22%. So, what's the let's redo that example. What's the probability of an 11% return on an annual basis or greater?
Quite a high.
Yeah, it looks like about 50%. Which makes a lot of sense, actually. You think about it. It's not a 5% chance a year, 11% return or greater. It's got to be more like, given the average return on the stock market, it's like 12 or 13%. It's got to be about 50%. So, yeah, so I should relabel this diagram monthly. Is this say monthly returns? No. Okay, well, I'll relabel that diagram. So what we're doing is we're using basically the distribution. We're assuming normality. Notice this is not exactly normal. There's some deviations, but it's pretty close. Okay, well, we're actually going to use the cumulative normal distribution, which I'm going to denote with a capital N. The cumulative probability is going to use a standard normal distribution. So if you recollect, what's the value of the probability of achieving a value up to 1.96? 97.5. So now up to 1.96. I think you're used to thinking of it in terms of a 2 standard deviation confidence interval. That's plus or minus 1.96. So you've got 2.5% on the left, 2.5% on the right. But we're always thinking of the value up to 1.96, which takes 97.5% of the distribution. Okay? And there's the normal distribution, which didn't turn out, but that's no big deal. You don't really need that. You don't need it because it turns out in Excel, they've got a function for the cumulative normal distribution. It used to be they didn't, and we had to use numerical approximation to it, but now they do, and it makes things a lot easier. Let's go through the notation. S is going to be the current stock price. K is the exercise price of the option. T is the time to maturity. S and K we know already. Notice it's not S star, it's S. K we know already. T is going to be the time to maturity in years. That's very important. So I say 5 months. It means 5 divided by 12. B is going to be the price of the zero coupon bond that has a value of $1 maturity. And maybe I should call that Z to be consistent with previous notation. So B and Z are the same. C is going to be the value of the call option today. PVD is going to be the present value of the dividends to be paid prior to maturity. Sigma, and that's supposed to be the Greek sigma, but Netscape doesn't recognize any Greek symbols. So that's sigma for now. Is going to be the annual standard deviation of the rate of return on the stock. Okay, so 2 things that are important here. Annual. So it's going to be annual standard deviation. And there should be a word inserted here to make it redundant, but to emphasize the point, it should be the expected annual standard deviation. Standard deviation by definition is expected, but often we think of historical standard deviation. So if I gave you the returns for this stock over the last 12 months, so 12 observations, you could calculate the standard deviation of the returns, right? That's not necessarily what we care about for the option, because the option is from today to maybe 12 months from now. And what happened in the past is not as important as what people expect to happen in the future. So what's important for the option is not just the past volatility, but how people perceive the volatility is going to evolve through time in the future. And it's annualized, and N is the cumulative normal probability of a value less than X. And ignore that V skip, that should be deleted. It's vertical skip 0.15 inch.
You use continuous compounding when you merge the zero form. Would it make a difference between 1/1%?
No, it doesn't make any difference for that. Okay? Because all I care about is the price. I want the price of the bond. And I don't care if you get it with continuous or with discrete. Okay? We're going to be working in continuous returns now. Okay, so the previous formula for a percentage return is going to be the price today minus the price yesterday divided by the price yesterday, multiplied by 100 to get percent. Now we're going to be using continuous returns. The formula is the log of the price today divided by the price yesterday. And log, I mean natural log, always. So the log of the ratio of the price today divided by the price yesterday. That's the continuous return. The reason we do continuous is that it turns out, and did we lose the rocket scientist? That a lot of option pricing theory is borrowed from physics, where everything's developed in continuous time. The solution to the option pricing formula is just a version of the heat equation in physics, for those of you that remember that. If you don't remember it, don't worry about it. This is the formula. Let me scroll it down. It looks pretty bad in terms of formulas. But let me try to explain what's going on. And let me also make a correction, which I'll, when I get back to my office, correct. Everywhere where it's S minus PBK, that should be S minus PBD. At the break, somebody complained that when they try to code this up in Excel, you get crazy answers. Sorry. This won't give you a crazy answer. You put K instead of D. D is a small number. K is a big number. So it appears here. It appears in both these natural logs. But the denominator should be PBK. So that's correct there. Okay, so it's S minus PBD divided by PBK. In both of these, and up here, it's S minus PBD, and that should be PBK. Sorry. Now, where it says S minus PBK, that should be S minus PBD. Everybody got that? Apologize. As I said, I had to recreate all of these in a separate graphics package, and it's real pain. And that's one mistake. Okay, so this is the formula, and let me try to give you some intuition on the formula.
How do we get D?
How do we what?
Where is D? Is D is stated? Dividend?
Yeah, okay, D is, we're going to assume is basically given. So a firm would announce the dividend well in advance, And even if it's not announced, that you can forecast with great accuracy what the dividend is going to be. 98% R squared would be the prediction that the dividend is the same as the previous period. So firms infrequently change their dividend level, and it's pretty smooth. There's also firms that exist that's all they do is forecast the dividends and the earnings. So you can buy a service that tells you what the dividend is expected to be. Okay, so this kind of looks like a mess, and I want to try to convince you that this formula is not as bad as it looks. Okay? So let me do it, and this is what we're going to do. Let's ignore the PBV. So let's assume that's 0, the stock with no dividends. And then what we've got is S times NX1 minus PBK times NX2. Next, let's ignore the NX1 and the NX2. So what's left? C equals S minus PBK. Now, is that somewhat familiar? What's the payoff at expiration to a call option? The payoff at expiration. At expiration, S star minus K at expiration. Well, we're not standing at expiration. We're standing today. So it makes sense that instead of K, we use the present value of K. And it also makes sense, to me at least, that you don't use S star. We don't know what S star is, right? Today, who knows what S star is going to be? And in fact, maybe the best guess, or the present value of S star, is what? S, the price today. It's the market's best guess. So in present value terms, we've got a formula, the basic kernel of the Black-Scholes formula is just what we've been talking about all along. S star minus K, but now we're just going to move to S minus PBK. That's not too bad. Now we're missing something. What we're missing is that we've got an S minus PBK today. But what we need is some assessment of the probability that S is going to exceed K. So we have to add that extra piece. So it's not just a matter of taking present value. All our previous examples, we just take present value because we knew what the cash flows were going to be. So we knew that there was going to be like an 8% coupon bond. It's got twice a year, $4. At the expiration, the maturity, $100. We knew the timing exactly of all the cash flows. Now we're talking about something different. We want to retain the intuition of present value, but our cash flows are not known because we don't know what's going to happen to the stock price, for sure. S is a lot different than the V that we've been using for a bond price. So what we're going to do is to apply to the S and the PBK a probability that this is going to this option is going to finish in the money. That's where all this junk comes in. Okay, so the NX1 and the NX2 look very similar, actually. The only difference is that one has a plus 1/2 sigma root T, and the other has a minus 1/2 sigma root T. And the reason there's a difference here is just it's a matter of the mathematics of what's called the log normal distribution. It's like the normal distribution, except we're in logs. Okay? And there's always a 1/2 sigma floating around in that distribution. But I want you to think of these things as kind of measuring the probability that we're going to finish in the money. Okay. So let me try to do a bit of an example here in our heads without putting the numbers to it. Suppose that S is way above the present value of the exercise price. They're way in the money. So S is 150, and the present value of the exercise price is like 50. Okay. And ignore the PVD. So let's say we do that, and the log of the ratio of 150 to 50 is going to be a positive number. I actually can't do it in my head. Don't have the log operator up there yet. It's going to be a fairly large number. Okay, and then we're going to add this piece to it. And let's assume that this really swamps the 1/2 sigma squared t. So let's say that when we do this with this price that's way in the money, that x1 is 3 and x2 is 2.9. Okay. So now let's plug in. The cumulative normal for a standardized normal distribution for a value of 3. What does that equal? Almost 1. 0.999. And 2.9. So basically it says that if your call option is in the money in a huge way, then the price of that option is basically S minus the present value K. Check it out. Go to the paper and try to find a situation like that. You're going to find it's very close. Okay. And you can see what happens here. That, well, suppose that the stock price is not even at the present value of the exercise price. So the ratio of the stock price to the present value of the exercise price is less than 1. What's the log of something less than 1? I can do that in my head. The log of a value less than 1, natural log, is that positive or negative? Negative. And then we divide by sigma root t, add 1/2, and suppose that it's still negative. Small negative number. Small negative. And again, let's say that this is also a small negative number. It's going to be even smaller. So let's say it's like negative 0.1, negative 0.2. So we go up here. What's the cumulative normal for a value of x1 of negative 0.1 up to negative 0.1? Say it again? Almost 50%. So it's going to be like 0.49 or something like that. Over here, 0.47. So what we've done is that given that we're not even at the present value of the exercise price yet, we've applied a different probability to our cash flows. Basically what we're doing is we're making our cash flows expected cash flows with this formula. We're applying a simple normal distribution to help us out. Now it turns out that this formula, hopefully you can see that this formula is like real easy to code up in Excel. And for 2A, I asked for that, but obviously we'll do that later on for 2D. And it's really just a couple of lines because you've got the most complicated thing in this formula is the cumulative normal. So just define x1 and x2, and then it's a one-liner in Excel for the Black-Scholes formula. This is stated, this is everybody knows the Black-Scholes formula. And I really believe, well, you can get a calculator that's got a Black-Scholes button maybe, but I believe that you need to be able to at least set this up. You should be able to do this in Excel. Right? So, and maybe that's a little different from another school where you just give it the formula, right, or use some canned software package to get the option price. But if you can actually put it into Excel, I think it shows that you've really thought about the formula. And it's difficult to squeeze a lot of intuition out of this formula, but you know, it's very useful. It's invented in 1973, actually, by Black and Scholes. And Black actually just passed away 3 months ago or so. And it's definitely something that he would have won the Nobel Prize for. It's had just a huge impact. Of all the things in finance, this has had more impact than anything else. And I think the Nobel Committee is a little hesitant to give prizes away to people that are mega millionaires, because both Black and Scholes did really well. Yes? No, it holds for a call. It holds for a call. Okay, so suppose that, this is a good question. Suppose that we wanted to value the put with an exercise price of 100 and the current stock price is 100, it's got 5 months to go, and there's no dividends. And I tell you what the sigma is. How do you get the put value? Put call parity. Somebody said it. So figure out the value of the call. You know the value of the stock. You know the present value of the exercise price. Just plug in the put call parity, you got the put. So the Black-Scholes model is presented in terms of a call, but is easily translated into a put by no arbitrage. Okay, the second thing before you go I want to mention is the sigma. Everything is really easy to get except the sigma. And the sigma is the forecast of volatility. Now, there's some firms that specialize in forecasting volatility. I even do some of that. Okay? But it turns out that there's a way to get the market forecast of volatility just by looking at the option price. So suppose that I observe the price of the call. I observe the stock price today. I know what the present value of the exercise price is. I know the time to expiration. I've got an equation here that's basically got one unknown, sigma. So if I got this set up in Black-Scholes, Black-Scholes formula set up in Excel, then what I can do is to try different sigmas to get the right-hand side to equal the market price of the call. Remind you of the internal rate of return question in assignment number 1, where we're trying different interest rates to make the right-hand side equal $94,000. Same intuition. Try different sigmas, more complicated problem, but try different sigmas to get the right-hand side to equal the left-hand side. So when we get the formula to exactly deliver the call option price that we see in the paper, then what we've done is backed out the market expected volatility for the life of the option. That's called the implied volatility. Okay, so what we're going to do next is to go through, and unfortunately we can't bring laptops into the exam. We're going to have to use some option pricing tables for Black-Scholes, and I think they're pretty straightforward. You've actually got a hard copy of the tables in the lecture packet, or the course packet, and they're tacked onto the end of the midterm exam. The tables are also available on the web, but they're more difficult to read, I think. They're very wide on the web. So next time I'm going to start to do some examples on the Black-Scholes, and we'll talk a little bit about futures, and then the review of the midterm from last year. Okay?
I'm just going to tell you, Friday.